All right, let's jump right in. We're going to pull back the corporate curtain today. And no, this is not some stuffy accounting lesson. Think of it more like an investigation. We're going to be looking at the work of, well, corporate detectives, the people whose entire job is to figure out if the numbers a company reports are actually, you know, true. I mean, think about it. It's a really simple question, but the stakes are huge. Whether you're investing your savings or even just working for a company, you are betting that their financial claims are real. But what if they're not? That's the fundamental problem we're going to tackle.
And that's where our detectives come in, auditors. They're the independent inspectors of the financial world. And their job isn't just to, check the math. It's to find the truth, to follow the money, and to make sure the story a company is telling with its numbers is a fair one. Okay, so let's open our first case file. This is a classic, a really common internal crime that happens way more often than you'd think. It's called the Phantom Payroll. So here's the scene of the crime. Someone on the inside was literally creating ghost employees and paying them real money right into their own bank account. It's a pretty clever scheme, right? But as any good detective knows, every scheme leaves clues behind. So where do you even start? Well, the first place an auditor looks isn't at the individual paychecks. It's at the company's security system, what they call internal controls. These are all the rules and procedures that are supposed to prevent this exact kind of fraud. So if the crime happened, it means a control must have failed somewhere. And boom, here's the clue they found, the control deficiency. This was a huge weakness. Pretty much any clerk could change critical payment details with zero oversight. So the control recommendation, the fix, is to lock that down. Only a senior manager should have that power, and you create an exception report, which is basically an automatic alert that flags every single change. That way, someone is always watching. Now, to investigate something like this, auditors use two key techniques. First is a test of control. The best analogy for this is checking if the security cameras are actually on and recording. They're just making sure the company's safety rules are being followed. Then there's the substantive procedure. Now, this is the real forensic work. It's like dusting for fingerprints. Here, they trace the actual money, they pull bank records, and they calculate the exact financial damage. All right, let's move on to our next case file. This one's a little different. It's not about a crime inside the company. It's about the detectives themselves. Because what happens when the detective might actually be compromised? See, here's the crucial thing you have to understand. An audit is only valuable if the auditor is independent and objective. An ethical threat is basically any situation that could put that objectivity at risk, anything that might make our detective look the other way. A really common one is something called the familiarity threat. This is what happens when an auditor gets a little too cozy with their client. Maybe they've been auditing the same company for a decade, or maybe they have personal friendships. The risk is that they become too trusting, too sympathetic, and they stop asking those really tough questions. And the rules for dealing with this kind of thing are crystal clear. In a situation like this, where the son of the lead audit partner lands a job at the company being audited, the safeguard is immediate and it's absolute. That partner has to be removed from the audit. No discussion, no exceptions. So why is it so strict? Well, it's because the entire system is built on trust. Investors, banks, the public, we all rely on the auditor's report to be a fair, unbiased assessment. If that trust disappears, the report is basically just an expensive piece of paper. Okay, for our final case file, we are shifting gears one more time. Auditors don't just hunt for fraud that's already happened. A massive part of their job is to look for warning signs, signs that a company might be heading for a disaster. Just take a look at these numbers for a company called Epica Co. You really don't have to be an accountant to see the story that's being told here. From one year to the next, literally everything is heading in the wrong direction. Revenue's down, profits down, and maybe most importantly, their cash is just drying up. So let's start at the top. Their revenue has fallen by 17%. That is a serious decline. It means customers are buying significantly less from them, but that is only the beginning of the story. Because that 17% drop in sales, well, it triggered a staggering 74% collapse in operating profit. And this rate here is a critical insight. It shows you just how fragile the business is, where just a moderate drop in sales almost completely wiped out its ability to make any money. But of course, the numbers are only part of the detective work. Auditors also have to gather intelligence from other places. And in this case, they found out a new competitor was stealing their customers. A super important loan was in jeopardy. Key talented people were jumping ship, and a huge product launch just totally flopped. I mean, These are all massive, massive red flags. So all of this evidence, the financial numbers going down and all these real-world problems, it all leads to one of the most important judgments an auditor can make. They have to decide if the company is a going concern. And in plain English, that just means, based on everything we know, is it likely this company will still be in business 1 year from now?
So, after all the detective work, after chasing down all the clues and looking at all the evidence, the auditor has to deliver their final report. This is it. This is their verdict on the fairness of the financial statements.
And that verdict comes in one of 4 main flavors. The best one you can get is an unmodified opinion. That's a clean bill of health. Then there's a qualified opinion, which is kind of like saying, yeah, things look mostly okay, except for this one specific thing. Then you get to the adverse opinion. This is a major red flag. That means the auditor thinks the financials are actively misleading. And finally, you have a disclaimer of opinion. That's what happens when the auditors were blocked from getting the evidence they needed, so they just can't give a verdict at all. So there you have it. Auditors are our corporate detectives. They are the guardians of financial trust, and their work is absolutely essential to making sure there's a fair market for everyone. Which, of course, leaves us with one final and pretty crucial question to think about. Who audits the auditors?